Welcome to another episode of Trail Profit, where we help small, mid-sized businesses navigate the world of big business to increase profits. In the last episode, we talked about specific reasons why a business owner might consider owning their own property, their own retail space, office space, industrial space, whatever industry you're in or whatever you might need for your business, and some of the reasons you might get into a building. So if you haven't watched that episode, go back, because that'll help explain this episode. In this episode, we're going to be talking about how do you get into a commercial space. And so right off the bat, what I would tell you to do is talk to your accountant, talk to your banker, because what they're going to help you appreciate is this is a rent replacement type deal, meaning you're currently paying rent, you're currently paying a lease rate, and so based on that payment per month, back it in, what could you potentially afford as far as a type of a building. Now, I haven't looked as of today, but if I find something out there that can help you calculate that, I'll put that in the description of this video. But if not, that would be a good resource, good place to start. So once you get that figure in your mind, one of the things you'll want to do is look at the different loan programs out there. Because from a conventional standpoint, if you were going to get into a building, your bank is probably going to ask anywhere from 20 to 25% down. It could be a couple of different factors that determine how much down payment they're going to require. It could be, how many years you've been in business. Is that building a special use facility? For example, can it only serve one purpose? Or if you needed to sell the building or they needed to take it back, could they put another business in there easily without having to do a lot of TI work or tenant improvement work, or adjusting the building somehow, some way, so that they can get repayment, or you could sell the building, either way. So let's just, for our discussion here, let's just say they're going to require 20% down. And so on a 20% down building, let's just say if it's a $2 million building, and that means you're going to have to come to the table with $400,000. Now, most banks will do a 10-year term. Maybe there's a reprice in there, meaning, after a certain number of years, they'll look at the rate and determine if it's higher or lower based on what the market's doing, and readjust your pricing accordingly. And the reason they do that is because, typically these are larger loans out there, and they need to ascertain from a risk standpoint if they need to raise or potentially lower your rate. So sorry about the noise here. Give it 1 second, let this guy pass. So that's that. The rates, again, you could check around different banks or talk to your banker and see if they, because of the relationship, they can give you a special rate there. So they'll usually amortize that out for 20, 25 years. And what I will do, because I have a loan calculator, I'll put that in the link so that people can have that. That can kind of determine what your payment would be based on today's rates. There's other programs out there that I think are extremely useful. If you have the cash and you can invest that into your building, great, do that, because that means your loan payment isn't going to be as much. But for most businesses, on that type of a dollar amount, that's going to take a lot out of their accounts. It's going to take a lot out of that individual business owner that is no longer in working capital. So a couple of programs that can help mitigate that. First is the SBA 504 program. Now, they're administered through what's called certified development companies. And if you Google for your area, certified development companies, SBA 504 program, you'll find companies in your area that administer this program. You could call them directly, or your bank may even have ones that they're familiar with and they like doing business with. The nice benefit to this program, so long as it's owner occupied by at least 51%, meaning if, let's just say it's a 10,000 square foot building and you occupy 51% or 5,100 square feet of that building, it allows you to come in with only 10% down. So on that $2 million building, that's 200,000. So it makes it a lot easier as far as entry access to get into that building. And the nice thing about it is the SBA 504 portion has its own loan, so 40%, the bank does 50%. On that 40%, that rate is fixed for 25 years, up to 25 years. So it'll really help you as far as navigating maybe interest rate concerns, because you'll know what that rate is and it's fixed. Now there's some caveats to that program. There's a prepayment penalty you have to look at, some eligibility requirements. So, do your due diligence and when searching out that program, but your banker and these folks will know if you would be able to qualify for that program. So that's another way. The third way we're going to talk about here today is the SBA 7A program. Very similar to the 504, but it doesn't have a third party. It's solely your bank that's going to be doing this, but it allows for a lower down payment. Again, it could be as low as 10, sometimes 15% that's required to get into a building. So again, helps mitigate that cost of entry into getting into your own building. Typically, again, they follow bank policy as far as loan length and amortization. So check with your bank as far as on a 7A what they'll do as far as term and amortizations, things of that nature. And one of the other ways, the fourth way we're going to talk about here, which I don't think a lot of people think about and or pursue, is owner carry, seller financing. I personally think it's a really great avenue to try to look to see if you can get it done. So let's just say you're looking at a building, an industrial building. It's a $2 million building. The owner wants that residual income, and so they'll give you some nice terms. It could be that they only give you a 5-year term and they want you to refinance it. That's fine. But at the same token, they give you a really good rate, below market rate, because of wanting to get this building sold. So that could be a great avenue to pursue. How would you go about finding one of those? Certainly if you're dealing with a commercial real estate broker, having him focus his efforts there to say, hey, I'd like to find a building that the seller is willing to own or carry. It could be in your industry, some folks that maybe are getting close to retirement or have a building that's been on the market for a long time. You could possibly go up to them and say, hey, have you ever thought about owner carry? Would love to look at your building and see if that would be a possibility. So you just never know, unless you ask. Sometimes if they have a loan on it, that might not be a possibility, but you'd be surprised how many buildings out there are free and clear that the owner would be willing to entertain an owner carry. What's the benefit to the owner? Well, they get that income for spread out over a number of years, and there could be nice tax benefits to that. So those are just a few different ways in order for a business to get into a building, to look at research and just give you some thoughts as to how you might go about that. Again, we talked about the reasons you want to get your own building or potentially get your own building. So once you can find and locate that building, those are some of the ways that you might finance it. So, well, that's it for today. We'll see you in the next episode here on Trail Profit. And just ask that if you enjoyed the material today, please like and subscribe. But also, if you have any questions or want me to go over in more specifics any of these programs, just leave a comment in the comment section, and we'll certainly look at doing that. Well, thanks for watching.